Anytime.
Okay. Oh, these are great. Good evening, everyone. Welcome to our finance seminar for business owners on free cash flows. When you take a look at magazines and articles that appear in Wall Street Journal or Fast Company or Business Week, one of the major things that they talk about in terms of business or company failure is lack of cash flows. So tonight for the presentation, we're going to be doing a couple things. We're going to, one, define free cash flow. We're going to look at the benefits of positive free cash flow. We're going to look at how to calculate free cash flow. We're going to examine negative cash flow because it's not always necessarily a bad thing. And finally, we're going to wrap up with some key takeaways. Free cash flow, what is it? This is the classical definition of free cash flow, and then I'm going to expand a little bit from there. So free cash flow represents the cash that a company has after laying out the money required to maintain or expand the company's asset base. So what does that mean? Essentially, that means free cash flow is the cash that you get from operations minus the money that you would actually be investing into machinery, buildings, etc. So what are some of the benefits of positive cash flow? Well, you can develop new products, you can make acquisitions, you can pay dividends, reduce debt. You can also beef up your sales force, expand internationally, and also invest in more property, plants, and equipment. And so the value of not only having cash flows for these things, which is good for the company, but in addition, it actually enhances your shareholder value, which of course is very important. So how do you calculate free cash flow? All right, here we go. Free cash flow equals EBIT, which is earnings before interest and taxes, times one minus your tax, plus depreciation, minus CapEx. Now, CapEx are capital expenditures that I mentioned before, minus your increase in net working capital, which is basically all the things that you need to run your business, minus other cash payments. And other cash payments, there are cash interest paid and other cash obligations. So after you kind of do that calculation, right, so you're either going to get a positive number or a negative number. So now the question is it bad necessarily to have negative cash flow? And the answer to that is no. As a matter of fact, no all the time. Now let me clarify that. Yes, in some certain circumstance, situation, negative cash flow is bad. However, there are times where negative cash flow is simply indicative of very large investments that you're making that could potentially bring good return and actually be a very good long-term investment for your company. So at the end of this presentation, I'm hoping that you're coming away with the following things. One, I'm hoping that you understand the definition of free cash flows. Second, I hope that you know how to calculate free cash flows. And finally, I hope that you're coming away with the ability to be able to evaluate positive free cash flows and negative free cash flows within the context of long-term viability for your company. Thank you.